I think gold and treasury bonds will be some of the best, and I think the overall stock market will be, along with, well, it's not fair to say natural gas. It's already down. I predicted, it suggested it would go down. I would say from this point on, the equity market will be one of the worst performers. I think it's very unlikely for the Fed to ease until risk assets drop to a new lower plateau. So the number one risk factor I think right now is I fully expect the S&P 500 to do what normally happens in U.S. recession, which hasn't even started yet, dropped 50% during the last two recessions, peak to trough. That means it gets closer to 3,000 than the current price around 4,000, and I'll roll.
According to Bloomberg's senior commodities expert Mike McGlone, the financial system has revealed inherent risks in the wake of multiple banking giant failures, and the technology industry is currently experiencing significant layoffs. He has cautioned that the forthcoming financial crisis could potentially surpass the Great Depression of 1929 and become the most severe of our lifetime. Mike, a financial expert, has observed that recent rebounds in the stock market, cryptocurrencies, and copper were fueled by hopes of a soft landing and potential easing by the Fed. However, he believes that the Fed is unlikely to take such steps until risk assets drop further. He predicts that a recession is almost certain to begin soon and warns that the bigger risk right now may be enduring deflation rather than inflation. This crisis could mirror the 1929 crash in scale, according to Mike. Make sure to subscribe to our channel and hit the bell icon for further updates.
Let's look at what produced the inflation and is it enduring? The answer is no. What produced the inflation we have right now is the biggest pump in liquidity in the history of mankind that's dumping the most rapid pace I've ever seen. You look at things like money supply, bank deposits. We're actually having a bank run at the moment. Bank deposits are running negative 2 to 3%, just like money supply on a year-over-year basis. So that's liquidity dumping. And that's a classic measure of economic cycles. You have all big booms in history come in the back of excessive liquidity, and all busts come as they contract. We're in that middle of that contracting stage right now. What just happened yesterday was OPEC cutting is almost the best sign ever of a good bear market when OPEC cuts their supply because they're panicking and they have to because they see the potential for demand contracting. What does it do in the meantime? As our economist Anna Wong at Bloomberg Intelligence pointed out, well, we were clearly calling for a recession in Q3. That might pull forward a little bit. We're clearly calling for inflation and the Fed to continue tighten. That might heighten the Fed's accelerate inflation. It helps and it alleviates the ability for plunging commodities to help reset the market. So that's one little factor. But the macro is what I pointed out. This is the biggest one, I think, in our lifetimes, and it's just getting started. And I'll end with this. The key thing I like to point out is we are at a stage right now, typically the Bloomberg Commodity Index on a 12-month basis is down 20%. Yeah, it's bounced a little bit yesterday and recently, but we've never had a period like that with the Fed when they were tightening, and the Fed and central banks are still tightening.
In 2023, gold may be poised to surpass its $2,000 per ounce resistance level, finally shedding its reputation as a boomer rock among crypto enthusiasts. According to Bloomberg Intelligence's macro strategist Mike McGlone, the precious metal is primed to break out. Mike made a tweet: "Crude gold could be worthy of a 100-year chart. The distortions of the pandemic may have been a one-off or precursor of things to come in the relationship between gold and crude oil. My bias is with the latter." In another tweet, he said, "What's been a sign of crude oil bear markets? Surprise hashtag OPEC supply cuts. When the price of Brent first traded the current price at about $84 in 2007, OPEC supply was approaching about 40% of global liquid fuel demand. Now it's closer to 30%.
I love to look at the price of gold divided by crude oil, and it's been upward. Certainly, if you measure the actual price, if you measure the physical, the investment, gold always outperforms because you have no store value. It does. I mean, you have no cost of carry. It's about the same. But one thing I like to point out is this trajectory, the price of crude oil, or gold versus crude oil, it's around 24 barrels of crude oil per ounce of gold, is the same as first traded in 1932. So that's just that shows the stability of gold versus most assets, but it's breaking out higher now, and it's doing it on the back of deflating indications from crude oil. The price of crude oil right now of $80 is the same price as like 2007. Gold's making new highs, and I think that's going to continue. So gold has been bumping above this 2000 level for quite a while. It's been driving people crazy and frustrating them. But now it doesn't have a significant alternative. It does in treasury bills. But the key reason not to hold gold the last 10 years was the U.S. stock market outperforming the world. Why would you want to hold this relic boomer rock when you can get annualized 9% in your Schwab account by owning an SPX fund. That's changed and changing. It just got way too far. So now it's the point where I think gold's ready to break out. Once we see that little pivot from the Fed, markets are starting to price for it. Gold should do what it normally does. It's the store of value. Now, remember, it did make new highs in the euro and the yen, and that's because the dollar is so strong. But usually means it's going to happen in terms of the dollar. But I look at it also. You got to be careful having that with gold without Bitcoin in that space. And one way to look at gold too is it's really also a measure of treasury bond yields. The treasury bond market last year had its sharpest backup, steepest backup in history by some measures. And now the prices are starting to go back up, yields are starting to go back down, and gold is just starting to tick higher. So I look at gold as similar to it was in 2007 and 8 when it was bumping up against what was around 700-800, and boom, it popped to 1,800 by the time it got to 2011-13. I think it's going to do similar and just get to 3,000 next, get above 2,000 and never look back. But that's actually very much not profound if we get this recession as predicted by most other indicators. A U.S. recession is quite good for gold, particularly as the Fed pivots, and also if we see that the U.S. stock market's not going to continue to outperform the whole world, gold's going to be a go-to.
When it comes to Bitcoin, the representative asset of the crypto market, McGlone anticipates that it will overcome regulatory challenges and resume its ascent towards $69,000. He believes that Bitcoin is headed towards becoming a worldwide digital asset and form of collateral, but he admits that he cannot yet predict its bottom. He is optimistic about Bitcoin, but he acknowledges the possibility of a third-quarter recession that could negatively impact risk assets such as Bitcoin. Nonetheless, he suggests that Bitcoin's decentralized nature will safeguard it against U.S. regulatory actions as regulators appear to be focusing more on the crypto industry.
And what happened was that actually happened in the Ethereum, the equivalent Ethereum, rallied about, I think it was, 10x or so was what I was expecting in Bitcoin. Of course, we had the miners kicked out of China. So it did not happen. Got high, was around 70. And I fully expect Bitcoin's going to return to that trajectory, but I don't know if the bottom's in yet. The key thing, about Bitcoin is it has something I've never seen before in almost any asset, certainly commodity, is definable diminishing supply and low in early days of adoption and becoming global digital collateral. I fully expect it's going to go that way. Now, there's bumps in the road, there's issues with regulation, but one thing we're seeing recently and lately is it's starting to shine as indestructible. The thing never stops trading. I'm just, from an ex-pit trader, when markets would lock up and you'd have halts and things, it's just shocking. And now this banking crisis, I think, is starting to define gold, Bitcoin as its value. As the last crisis really was its birth. Now this is defining it. But the key thing I'm worried about in the shorter term is the tide going out in all risk assets, like I mentioned, and Bitcoin being pushed lower. But right now it's showing what I think is going to happen is it's going to continue outperforming most risk assets. The key point is we're still pulling away liquidity, and it's still one of the most riskiest assets. I think it's eventually going to trade more like gold and treasury bonds, which it has been, but all assets have bounced this year. It's when we get that rollover in a recession in equities, I have to see how Bitcoin can outperform the key.
The current state of the global markets is reminiscent of the period leading up to the 10-year recession of 1929 to 1939, and experts warn that it may be even worse in Bitcoin. Maybe the best choice for macro investors, a pending recession could jeopardize its gains in the short term. Falling commodity prices may be a sign of economic slowdown, which could affect the Fed, economic growth, and gold. Our discussion for today concludes with the possibility of a prolonged bear market for crude oil. We encourage you to share your views in the comments section. If you found this content informative, please give it a big thumbs up and subscribe to our channel for the most up-to-date news and videos. We appreciate your input and look forward to hearing from you again soon.